Welcome to Retire with Purpose, a show specifically designed to help you maximize your financial confidence in retirement. Casey Weed is the CEO and Chief Visionary of Howard Bailey Financial, a certified financial planner and Wall Street Journal best-selling author. He's your host on Retire with Purpose.
Hey, I'm Casey Weed, and we believe in retirement strategies that are driven by meaning and purpose. Join us this week and every week as we discuss planning for your best retirement, pinpointing your purpose, building a rock-solid financial plan, and unpacking trending topics that could impact your financial future. Welcome to the show. Welcome to Retire with Purpose, the science of retiring with confidence, the art of living with purpose. This is your host, Casey Weed. Joining me, my good friend and co-host, Marshall Johnson, here with me to discuss retirement with you. So if you're at retirement, in retirement, near retirement, you're just seeking that coveted job optional status, you have found yourself a home. We've got a wide-ranging discussion for you today. As always, we're going to be hitting on market predictions.
Yeah, we're going to predict exactly where the market's going to go. Stick around, everybody.
Stick around. We're getting out the crystal ball. We're also going to be discussing fees. So we have a question coming from Silver Lake, Indiana, Fort Wayne, Indiana, South Bend, Indiana. Some really great questions. One in particular that I really love is, how do I know if the fee my financial advisor charging me is actually fair? We have a best of the podcast. You won't want to miss that as we bring on Dr. Wade Pfau, professor of retirement income. And we're also going to talk about your black sheep beneficiaries and how to handle that. But first, we're covering an article from our weekend reading for retirees and pre-retirees email series. And that is one email that goes out every single Friday from myself to you with commentary from myself on 4 different articles, 4 different topics that are trending topics in the retirement planning space, designed to keep you on top of the latest trends so that you can make the very best decisions for your financial future. Could be the latest in retirement income strategies, the latest in tax law that could impact your bottom line in retirement. However, this week, we're going to be hitting on an article about market predictions. And if you would like to get a link to this article, you can check it out in the show notes of the podcast at retirewithpurpose.com. You can also listen to our full-length, in-depth discussion of this article right there and sign up for weekend reading with your first name and email while you're visiting. This one comes to us from CNBC, and it is titled, Investors Handicapping the New Market Year See Similarities to 2010 Recovery and the 1999 Risk Binge.
Oh boy, 2 opposite situations, right? That just kind of highlights these type of articles that, everybody wants to know. It's the beginning of a new year. We had this happen last year. This is where we're at. Where are we going to go next year?
I always have fun with January of every single year. We've been doing this show for roughly almost 10 years now.
Wow.
And we get to do this every single year. We get to pull out that crystal ball and throw some numbers out. And you know how many times we've been right? Every single time. Because we've said, it's going to go up, down, or stay the same.
Yeah,
and it always does one of those 3 things. It always goes up, down, or stay the same. Now, if your financial plan is built on the market doing consistently well in order for it to succeed, then you don't have a financial plan. You have I hope this works out kind of plan. And us at Howard Bailey, we build plans that will succeed irrelevant of what happens day to day in the market or over the next year. And most people want to predict what's happening in the coming year by looking back throughout history. And that's what this article is doing, is it's taking you back through history to look at some years, specifically 2010, 1999, and the 1940s,
right.
3 different scenarios where the market looks very similar today that it did back then. And I've read many an article that points to a given year. So they'll point to 2010, they'll point to 99, they'll point to the 1940s, and they will just look at that one year in a vacuum and say, hey, look at all the reasons it looks just like this year, to argue that the market's going up or the market's going down. Whatever fits, whatever that organization is trying to sell, that's the year that they tend to use. But there is not a year in history that looks like 2020. There is not a point in time that looks exactly like today.
Right.
Every single year has unique circumstances and factors. Is the past the best predictor of the future? Yes, but over very long periods of time, not over a 12-month, not over a 24-month, not even a 5 or 10-year period. You have to look over 30, 40, 50-year periods in order to be able to utilize that history of the market as a predictor for what might happen here in the future.
Yeah, you make a good point that the history is a good indicator, but it's never going to be exact replay. And as this article points out, we can take some of the indicators today and match it up with 3 different periods of time that produced 3 different results, right?
Yeah.
You go back to 2010, early cycle recovery. It was early in the cycle. It was a little choppy. It was positive, for the most part, but it was a choppy recovery. Or we go back to 99 and say, hey, this was right before the market crashed. Or we go back to the 40s and go, you know what? We're about to boom.
Yeah, and one of the things that we would often do in our live events is we would look back throughout history and we would look over longer periods of time. We'd look at 10, 20-year periods of time. And some will say, especially if they're brokers just selling market-based investments, they'll go, hey, the market always goes up. And yeah, if we're looking at 30-year averages, the market has always gone up. But there have been 25-year periods, 10-plus-year periods when we haven't seen any returns in the market. And the reason that we go through that process is to tell you that the market doesn't always go up. It does go up over long periods of time, and you need a plan that's going to succeed no matter which one of these years we're going to be entering here in 2021.
Yeah, and so really that kind of goes back to a different story. It's more about what's going on in your life than what's going on in the stock market, right? Because if you are 35, 45, 50, maybe you still got 10 years to work, it really doesn't matter what the market's going to do next year. But if you are on the doorstep of retirement,
if you're within 5 years,
within 5 years of retirement or 5 years into retirement, you're in that red zone. You're in that heat map, baby, and you got to prepare accordingly.
That's when the short-term movements of the market can really impact you unless you have a plan to combat that. If we look at 2010, they said, well, it's very similar to 2010 because this looks a lot like an early cycle recovery, right? We came off of the financial crisis, the March 9th, 2009 lows. We started seeing quantitative easing. And then in early 2010, we see QE1, and then it gets a little choppy. They go, well, I don't know. Are they going to do another round of QE or not? They did do another round of QE, but we didn't know what was going to happen next. And today we have our second round of coronavirus stimulus being passed, and that's why it could look very similar. We have the stimulus bill being passed, the market takes off, and then they go, well, what's next? Are we going to see any more stimulus? Are they going to continue to hold interest rates low? Or are they going to go back and start rising interest rates? Are they going to go back and stop the stimulus and not give us any more? And if that's where we find ourselves, we could end up with a choppy 2010. But this is a different type of period of time.
It's much different, right?
The verbiage from the Fed is very different.
Yeah, and the article goes on to state, what we saw in 2008 or 07 to the beginning of March of 09, that was 18 months, right? That was a grinding loss where the market shed like 50% of its value and people had just washed out a lot of problems. We didn't really see that back here in March of 2020. We saw a sharp decline. I mean, the economy got shut down, right? We saw the market lose 32% in 16 trading days. Are we really at the early stage recovery, or are we at the back end of that recovery?
Yeah, and the Fed's saying, hey, we're never going to raise interest rates.
Yeah. There's zero forever.
Yeah, it's a different period of time, and we've seen so much money come off the printing presses. I think it's given us more confidence as market investors to go, hey, I guess the Fed's always just going to come in and rescue us. Yeah. The whole country's too big to fail.
Yeah, I guess they'll probably save us. Right?
Even though there is always going to be a day of reckoning. Then you could go back in 99. I hear a lot of people comparing it, I feel like, more to 1999 than anything else.
Yeah.
They're going, market valuations today are crazy. We're seeing valuations like we saw back in the late 90s before we saw the tech bubble burst. We had an overbought market.
Right.
And then you have different valuations too. You could say, hey, we're at the second highest market valuation in history. If you look at PE10, Shiller's ratio, which also won a Nobel Prize for predicting future stock market performance, that says we're in the most expensive market throughout history. And so is it an expensive market? Without a doubt. But you could also argue that it's a different time that we're in today than back in 1999 because of interest rates. Interest rates are so much significantly lower today that should push market valuations higher. Yep. So maybe we need to start the system's broken. We need to start looking at it differently.
Evaluating stocks a little bit differently. This article points out, like in '99, when Yahoo was added to the S&P 500, that's pretty similar to what we're seeing with Tesla being added to the S&P 500. But you could make a much different narrative out of that as well, because you look at value stocks today, and value stocks, dividend stocks, are still undervalued by growth comparisons. So you can fit this narrative to whatever you're trying to create. Just be aware of your plan.
I think one of the most beneficial pieces is the 1940s recovery discussion following World War II, because we entered World War II, didn't fare real well off the bat, and then we win something. We finally got a win. Well, you could kind of compare that to what we saw during what's going on with the coronavirus. We go, hey,
we got a vaccine.
We've got a vaccine. Everything's going to be okay, and yet we still have continually very negative numbers around deaths and
Might
coronavirus.
Be a long haul.
Oh, it could maybe be years before we actually get out of this. And yet back in the 1940s, after we saw that first win, the market bottomed and it continued to rise, even though we hadn't seen the worst of the war yet. We hadn't spent, expenses continued to rise, death toll continued to rise. We weren't even near the end of the war. However, the market continued to rise in the future. And maybe that's where we find ourselves today.
Yeah, because, the market pundits, we didn't have bloggers and things back in the 40s, but you can imagine they're going, why is it? They wouldn't believe that stock market rally. The first month, the second month, why would the market be going up? We're in the midst of this terrible war. There's so much doom and gloom and death on the horizon. Why would the markets be going up? And we saw something similar here in the summer months when people were doubting the recovery that they had seen since the March bottom in 2020. There's always going to be doubts. There's always going to be fears. You're never going to know exactly how the market's going to play out.
And if you want to determine if you're prepared for no matter what happens next, we can give you a portfolio stress test. Just give us a call right now. We'll stress test your overall plan to see how you fare no matter what the market does next year, over the next 10 years for that matter. And that's a valuable thing that you need to implement into your financial life. If you'd like to take advantage of that, give us a call right now, 866-482-9559. We will stress test your portfolio for what might come next. And if you're just trying to create a foundation for the new year, then maybe you want to take advantage of my Wall Street Journal best-selling book, Job Optional. We cover everything from tax planning. We cover creating a framework that makes it so you don't have to focus on what's going on in the markets on a day-to-day basis. If that's what you're working with your financial advisor on, if they're always predicting what's going to happen in the market today, the next year, the next 5 years, then I would say you're working with a money manager and you don't have a real financial plan. Give us a call right now. We'll get you a free copy of my Wall Street Journal best-selling book, Job Optional, at absolutely no cost. And that might be just what you need to get the ball rolling in the new year. 866-482-9559. We'll send it out to you at absolutely no cost. 866-482-9559. Next up, we have questions from you. We've got Annalise in South Bend, Brock in Silver Lake, Martha in Fort Wayne. Stick around.
First-time callers are eligible to receive one in-stock book per request. Limit one book per week per household, up to 3 books per calendar year. See full terms at howardbailey.com/terms. You're listening to Retire with Purpose, hosted by Casey Weed and Marshall Johnson. This is Retire with Purpose, hosted by Casey Weed and Marshall Johnson.
Welcome back to Retire with Purpose, the science of retiring with confidence, the art of living with purpose. This is your host, Casey Weed. Joining me, my good friend and co-host, Marshall Johnson. And this is our opportunity to turn the mic over to you and see what kind of questions you have. What are those burning desires? What are those things that keep you up at night that you'd like to get off your chest? Maybe you have a neighbor that told you something recently. I don't know. I like the guy, but does he really know what he's talking about? Maybe your financial advisor told you something. You go, that doesn't sound right. Well, go on over to retirewithpurpose.com. In the bottom right-hand corner of the screen, it says Ask Casey a Question. Just drop your question right in there. We'll get you an answer. No cost, no obligation. We're just here to serve. And then if you'd like to have the question featured here on the radio show, we will do that for you. And that's what we did here with Annalise from South Bend. Annalise says, can you explain income annuities? How do they fit into a retirement plan?
Annalise, what a great question. How much time do you got? Casey, you got about half an hour. We can go through all the ins and outs here. Income annuities, there's a few different forms, but to generalize them, listen, this is something that you're going to be drawing a consistent, reliable stream of income for a period of time. This could be 10 years, 15 years, 5 years, or it could be guaranteed for the rest of your lifetime. But most of the time when people are talking about retirement planning with income guarantees or income annuities, they're hoping for what, Casey, a paycheck? A retirement paycheck?
Yeah, it's just a paycheck, right? It's the simplest form of annuity there is. And that's why you'll find it discussed and researched more than any other type of annuity, because it's very simple for them to implement this into a financial projection, right? And this is what most people think of as an annuity. You hand over a lump sum to an insurance company. They guarantee you an income you can't outlive. You lose control of the lump sum. If you pass away tomorrow, you lose. If you pass away 40 years from now, you kick butt,
you win.
Right? And that's really that's how they work. They're very simple. And a lot of the research out there is around them for the reason I said. One of my favorite books in regards to this was written by my professor during my retirement income certified professional course, professor of retirement income, Dr. Wade Pfau. He is the premier expert in the area of retirement finance. Actually, you should check out our episode number 121 on the Retire with Purpose podcast.
Yeah, that's a good one.
You can check it out at retirewithpurpose.com. Listen to that. He talks extensively about income annuities and how they can be integrated into a financial plan to not only provide you more confidence to spend in retirement, but actually he shows you how it can create more wealth for your heirs over your lifetime as well. And we have actually a few copies of his book left here in the office. We'll send them out to you at absolutely no cost. He had sent us over a box of books. We're still giving them out. It is the Retirement Researcher's Guide series, Safety First Retirement Planning. I will warn you, it is an academic journal.
It's a little thick.
It's very thick, but it's very thorough. It's the best book out there that I've seen on retirement income planning. And again, just give us a call right now. We'll send it out at absolutely no cost. 866-482-9559. 866-482-9559. Largely what the research shows is that income annuities play the best role in those paychecks. So the funds that you can't live without, right? Mm-hmm. The income that you absolutely have to have to cover your essential needs, your non-discretionary expenses, that's where they best fit in. Now, towards the end of the book, he'll show you how income annuities don't actually provide the best income guarantee. And that's where I learned something, in reading this a while back was, I always wondered, why do fixed indexed annuities provide a higher guaranteed income than a basic income annuity? If I go to an income annuity, I totally lose control of the lump sum. I should get more income than if I use a fixed index annuity where I retain control over the principal. It's going to be left to my heirs. I'm still have the ability to take excess free withdrawals and take more income if I need it. It's more flexible. However, it provides more income than what you would see with an income annuity. And you have more control. I go, well, why is that?
Right.
Well, with an income annuity, the insurance company knows 100% you're going to take that guaranteed income payout. With a fixed indexed annuity, they know that only a fraction of the individuals that put that income guarantee on that product are actually going to utilize the income guarantee, so they're able to collect additional fees. And that means you're getting subsidized. If you have a fixed index annuity with an income guarantee, you actually use it, all those other people that didn't use it are paying for you to get a better income than you could get if you lost control of the lump sum and annuitized.
Well, and I think that makes a lot of sense to us because we sit down with lots of families every day who are walking in and they've got, I've got this annuity or that annuity, and they've got income riders and guarantees and roll-ups and things that they don't understand. They don't know why they purchased it. And they don't know what role it plays in their overall plan.
Mm-hmm. A lot of the problems I see, the complaints about annuities today come from individuals that were sold something they didn't need. They were using an annuity when the person didn't need an annuity. They were putting an income rider or a death benefit on there when they didn't need an income rider or a death benefit. And unfortunately, that is benefiting those that actually are using it as a piece of a financial plan. Annalise, I hope you find that helpful. I hope you check out episode number 121 of the Retire with Purpose podcast.
Next up, we've got Brock in Silver Lake, Indiana. He says, Casey, if I'm planning on retiring in the next 5 years, should I focus on getting out of the stock market now and looking at other safer investment options?
Brock, great question, and it's one that we get all the time. I No offense, I think your focus is in the wrong place. Your focus is where most people's is, which is, hey, I'm getting close to retirement. I can't afford the risk anymore. I need to get out and I need to find safer options. That's not true, because your focus is on risk when it really should be on income. It's all about taking that retirement asset that you've accumulated and turning it into an income you can outlive. And we'll find this with couples that'll come in and they'll say, hey, I need to get out of the stock market. And say, why? Well, I'm out of time. We look at their Social Security, their pension income, and their expenses, and all of their income needs are covered by their Social Security and pension. And so they don't need any of the dollars that they've saved over the years. Right. So maybe they don't need them for 10 years. Maybe they don't need them for 20. Maybe they don't need them at all. So what is the lifespan of that? There was a principal that I worked with from West Noble a while back, and he was in his late 70s, 100% equities. Yeah, because he didn't need. And people would look at him and go, boy, this guy, he's taking way too much risk for his age. That's what the textbooks say. That's what the talking heads say. However, he didn't need any of the money. Great pension, great Social Security. And he said, my time horizon isn't my time horizon, it's my kids. It's the kids. They're not going to need this for 30 years, so I'm investing this like I was 30 years younger, which is 100% equities in his case. So your focus needs to be on your income and expenses. That's where you start, and then you want to look at the next 10 years. Let's say that you need income in 5 years to last another 5 years. I want to look at it in 10-year increments. Statistically, that's what we should do. And so we might need to set aside a portion of that portfolio to ensure that your income needs are covered over the next 10 years. Right. And then we want to put together a different strategy for those other assets. You still have a long time horizon left. When you are 60, your life expectancy is about 85. You're still investing for the next 25 years. However, your time horizon is laddered now. You don't have 25 years on 100% of your portfolio. You're going to want to carve out a portion of that, at least a portion of that, to cover your near-term income needs, so that you don't have to worry about what happens in the stock market over the next 5 to 10 years. Right.
And so the challenge there is a lot of individuals like Brock, they look at retirement as a finish line, right? And what you just illuminated was the finish line is your life expectancy. You and your wife, your life expectancy, and looking at it in that way and understanding what a required rate of return is, that's where you go back and you look at your income sources and you figure out what you want to spend on a monthly basis. And you go, okay, our gap is this much. Now you're solving for the gap specifically in those 10-year increments.
You should check out another episode of the podcast, episode number 8, with Emily Guy Birkin. She wrote the book, The 5 Years Before You Retire. Ooh. Check that out. We'll also, I believe we still have a couple copies of that laying around that we could get out to you as well. Give us a call, 866-482-9559. Our next question, last question here, comes from Martha in Fort Wayne. She says, is there a way to find out if the fees my financial advisor is charging me are fair? How can I be sure I'm not paying too much in fees?
Martha, that is a wonderful question. And like a lot of businesses, if you're paying somebody to do something, you'd like to know how much you're paying them. And unfortunately, in this business of financial advisors, planners, sometimes it's not always transparent. And so the first step is understanding how much you are paying and understanding that fees come in many different forms and fashion. If somebody says, well, I'm paying my advisor 1%, well, that may be very accurate. That's his advisory fee. But if they're turning around and using mutual funds, there may be a whole nother 1% in cost of those instruments. So understanding total cost is very important. There was a great article written by Michael Kitces. I think we talked about this earlier. It was back in July 31st of 2017, and it talks about what fees are out there, how advisors are paid, what's normal, what's rational. Advisory fees for AU can be based on tiers, how much money you have invested, and it's all a bigger discussion, I think, Casey, when it comes back to fees versus value, cost versus value.
I think that's really important. But and before I get to that point, look at that article. I utilize it all the time. And you're going to pay more in advisory fees if you have less, and you're going to pay less in advisory fees if you have more invested. If you look at an individual that has in that $1 million to $2 million range invested with their advisor, their average advisory fee is 0.85%. Okay, but that's not it. It's because you still have financial planning fees, you have, fund expenses, you have maybe third-party money management expenses. There are going to be other expenses involved in having that comprehensive financial plan or just that investment portfolio itself. And the study showed in that article that 0.85%, on average, the all-in cost is actually 1.5%. And if you're trying to figure that out for yourself, you know what your advisor fee is, 1% maybe, 1.5%. And then one of the tools I like to use is Personal Fund. You can go to personalfund.com. You can plug in the actual funds in your portfolio, and you can see what the all-in cost is.
Right, that's good.
And I have one that I was just looking at recently, one that we did for a couple of while back. They had about $250,000 invested. Their advisory fee was 1.25%. And on average, someone in that range would pay 1%. So they were a little high, 1.25 versus 1% on average.
Yeah.
And the average all-in cost in that scenario is usually 1.75%. Their all-in cost was 3.09%. So on $230,000, it was $7,000 a year. Their funds were costing them over 2%.
Wow.
They had a T. Rowe Price fund that had a prospectus expense of 0.5%, all-in expenses of 3.6%.
Yikes.
And all they were getting was money management. They saw their advisor once a year, and there was not a plan put in place. There wasn't a plan for retirement income. There wasn't a plan for their estate. There wasn't a tax strategy put in place, a healthcare strategy put in place. And as Marshall said, it's all about the value you actually receive in the end. If you're not sure what kind of value you're receiving right now, we're offering a complimentary financial review to you. You'll meet with an independent advisor on our team, either in person or through a video meeting from the comfort of your home, and we'll help determine how prepared you are to handle all of the retirement pitfalls that you will face: inflation, healthcare emergencies, stock market crashes, rising taxes. In short, we're here to take the guesswork out of financial planning for you, and it can take just 30 minutes. Call right now, 866-482-9559, 866-482-9559. We'll be right back after the short break.
First-time callers are eligible to receive one in-stock book per request. Limit one book per week per household, up to 3 books per calendar year. See full terms at howardbailey.com/terms. You're listening to Retire with Purpose, hosted by Casey Weed and Marshall Johnson. This is Retire with Purpose, hosted by Casey Weed and Marshall Johnson.
Welcome back to Retire with Purpose, the science of retiring with confidence, the art of living with purpose. This is your host, Casey Weed. Joining me, my good friend and co-host, Marshall Johnson, here with me to spotlight our top 4 podcast releases since inception. So we're just crossing that 200,000 download mark. We have done, 200 episodes we've recorded, something along those lines.
Yeah, that's a lot.
We've had some amazing conversations, some incredible guests in every area of finance and retirement and purpose planning you can possibly imagine. I strongly encourage you to check out the podcast. Go to retirewithpurpose.com, click on the podcast tab. That'll give you all the links you need to go back and listen to all of these discussions. We wanted to highlight these to give you a little taste of the ones that we enjoyed the most, so that you could go back and listen to them if you find them as interesting as the mass majority of the individuals that listened in really did. And we also have a January giveaway. So for 2021, we're going to do a big book giveaway, because all 4 of our top downloaded podcasts, all 4 of these individuals were authors that sent us over some books. Nice. And we want to get rid of these books coming into the new year, as we have some world-class guests lined up for 2021. So give us a call as we go throughout this episode, and if you hear something you like, we will send you out a copy of their book. We're going to be kicking it off with episode number 106, where we featured Dr. George Schofield. George is an entrepreneur, a consultant, an author, a public speaker. He helps businesses and individuals develop new, smarter approaches to life planning and retirement planning. He has helped countless retirees get past the feeling of, I don't know what to do, and build a framework for life with change in mind. He wrote the book, How Do I Get There From Here? Talking about retirement planning in this modern age. If you'd like a copy of his book, give us a call right now, 866-482-9559. My favorite line from this interview was when George said, when can I retire is a bozo question.
For me, when can I retire is the bozo question of all time. Not because it isn't a piece of data, but that's all it is. Normally when somebody says to me, when can I retire? What's going on underneath that is they're going away from something. They want to get away from something that they don't no longer like or is uncomfortable, but they're not necessarily going towards something. And why it's a bozo question for me, I realize if you're doing financial planning, when can I retire and how much money do I have to make? That's not in the bozo category for me because it comes down to actual financial planning, which you're great at. If somebody comes in my door and says, when can I retire? The quality of the question always drives the quality of the answer. And if the question is, when can I retire? There's no consideration for what am I going towards? Who do I want to be? What would I like my life to be like? What would it take to make that happen? And by the way, what has served me well all this time that I probably shouldn't take forward with me because it'll just be baggage and weight.
Whoa. Well, my favorite line, and I've used this ever since episode 106, was the quality of the question always drives the quality of the answer. That's one of my favorite quotes from any guest that I've ever had on the podcast.
So true.
The next interview that we want to spotlight was with David Mcknight, a worldwide recognized author, nationally known tax expert, and author of the best-selling book, The Power of Zero. David Mcknight got this book to the number 2 most sold business books in the world at one point, and he dedicated his career to warning us all why we should expect higher taxes in the future and how we can achieve the 0% tax bracket in retirement. We've given more of these books away than any other book on the shelf. If you'd like to get a copy of The Power of Zero, give us a call right now, 866-482-9559, 866-482-9559. Well, let's hear it from Dave, how he shares with us that your taxes could be higher in retirement.
So all of these major source of deductions vanish into thin air right when you need them the very most, which is retirement. So even if tax rates weren't going to go up, which I think is a mathematical impossibility at this point, all of the deductions that we enjoy during our working years are gone. And the only thing we're left with is a standard deduction, which if you retire today as a married couple is $24,400. So we've got the combination of disappearing deductions plus the likelihood that tax rates are going to go up, which make it nearly impossible for you to be in a lower tax bracket than you are right now in retirement. Having said that, everybody's situation is different. And the real catalyst that should help you understand what you should do in terms of whether you should shift money out of tax deferred to tax free comes down to what you believe in your heart of hearts about the future of tax rates. That is the single overriding variable when it comes to making these decisions. I happen to think, having examined all of the data and having interviewed most of the major experts on these types of things all across the country, particularly for the movie, I happen to be very, very frightened about the future of tax rates. And that's why I'm so motivated to do the types of things that I'm doing.
We've helped client after client get to that 0% tax rate in retirement and achieve that power of zero. Not everyone has the ability, but if you have time on your side, you can absolutely achieve that in your financial life. And if you'd like to find out how, give us a call, 866-482-9559, and we will do a complimentary tax analysis for you. The next episode we want to spotlight from the Retire with Purpose podcast is our 2-time guest on the podcast. This is episode number 121. Dr. Wade Pfau, who is the creator of one of the top retirement blogs, the Retirement Researcher blog. He has dedicated his whole career to diving deep into the world of academic retirement research, finding practical applications and strategies to help retirees and financial planners, I would say financial planners most of all, achieve a better retirement strategy. He's a professor of retirement income, also my professor of retirement income at the American College, and the director of retirement research for Mcknight Asset Management. And he joined us to discuss his book, Safety First Retirement Planning, and how you can utilize many different financial products to get more income, more confidence in your income, and leave more to your heirs in the end. If you'd like to get a copy of his book, Safety First Retirement Planning, give us a call. We're still continuing that New Year's giveaway, 866-482-9559, 866-482-9559. Let's hear it from Dr. Pfau. What is the Safety First approach?
Yeah, so the safety first approach is really part of the academic research, and the investment-based approach really is more of a based on rules of thumb developed by financial advisors. I kind of say that the investments only style approach really goes back to Bill Bengen's research that led to the 4% rule in the 1990s. It was just, well, let's look at historical data and see how much you could have spent over different periods in history and kind of base our guidance on retirement around that. Whereas the safety first approach is based on academic research. And really the conclusion of the academic research is you build a floor so that your basics are going to be covered with some sort of contractually protected income. And then from your remaining assets, you can spend, it's more for the upside in the lifestyle. So you kind of, the rules around required minimum distributions provide an example of what you could do with your remaining investment assets. It's as you get older, you spend an increasing percentage of what's left every year for upside. And that's really the core academic approach. Build a floor to cover the basics and then be more aggressive and spend with an increasing percentage to cover more discretionary types of expenses.
That's Dr. Wade Pfau, professor of retirement income. I'd love to go to see Dr. Pfau with all of his years of academic research and the wealth of knowledge that he has go toe-to-toe with the I Hate Annuities guy.
Ooh, that'd be good. I would probably pay for that. Pay-per-view worthy broadcast.
Next up, we want to spotlight episode number 152 with Chris Hogan, none other than the Chris Hogan, the most recognizable voice in finance. You probably recognize him as his role on the Dave Ramsey Solutions team as a financial coach, but he is also a national best-selling author and host of the Chris Hogan Show and podcast. He takes calls from individuals all around the country, advises them on their personal financial challenges, mainly around retirement. So he's kind of like the retirement specialist of the Dave Ramsey team. He joined the podcast to share the lessons he's learned from working with the Dave Ramsey team and the happiest and unhappiest retirees over the last 15 years, how to define a retirement that works on your terms, and how to find the right person to help connect the puzzle pieces and bring it all together. He wrote the book, Retire Inspired, and we want to give that away to you at absolutely no cost. Give us a call at 866-482-9559, 866-482-9559. Let's hear from Chris Hogan why you need a financial coach and why most avoid it.
You see, I think when we have our dreams clear and we have a plan that's clear, that's an opportunity for us to do something. It's an opportunity for us to make an impact. But if we don't engage in this and we don't sit down with investment professionals to talk about our portfolio, to find out some things that we could do to go further faster, that's where we're leaving things to chance. And so I want people to grab opportunities, and that's not to be scared to ask questions, not to be scared to have a conversation. You know, Casey, you're in the industry, and most people believe that if you go sit down with an investment professional, that they're going to judge you, right? They're going to put their glasses at the end of the nose and look at you almost like a principal and tell you everything you've done wrong. No, those are the wrong ones. You don't want those. You want to sit down with people that are SmartVestor pros. These are people like you, Casey, that we talk about all around the country that have the heart of a teacher. They're not there to judge you. They're there to actually help you get to your goals.
That was Chris Hogan from the Dave Ramsey Solutions team on episode number 152 of the Retire with Purpose podcast. Check it out at retirewithpurpose.com or just hop on your iPhone and pull up the podcast app, search for Retire with Purpose, and start listening today. Every single Friday, I send out what I call weekend reading for retirees and pre-retirees from my desktop to yours on the latest trends in retirement. That could be on Social Security. It could be on tax planning. It could be on politics or what's going on in the investment world, what to look for in a financial advisor, what are the latest products out there you need to be aware of, or what's going on in the Medicare world. It could be anything that helps you stay on top of the things you have to in order to make the best decisions in retirement. We'll help you cut through all of the clutter that's out there and get really good, solid advice to your desktop at no cost to you. You can sign up for these articles at retirewithpurpose.com. Just scroll on down to weekend reading, first name and email, and you are signed up. Now for our question of the day. Over the next 25 years, how much wealth is projected to be passed down from today's retirees to succeeding generations? Is that $500,000, $3 million, $2.5 billion, $68 trillion? We'll have the answer when we come back.
First-time callers are eligible to receive one in-stock book per request. Limit one book per week per household, up to 3 books per calendar year. See full terms at howardbailey.com/terms. You're listening to Retire with Purpose, hosted by Casey Weed and Marshall Johnson. This is Retire with Purpose, hosted by Casey Weed and Marshall Johnson.
Welcome back to Retire with Purpose, the science of retiring with confidence, the art of living with purpose. This is your host, Casey Weed. Joining me is Marshall Johnson to answer our question of the day. Over the next 25 years, how much wealth is projected to be passed down from today's retirees to succeeding generations? Is that $560,000, $3.2 million, $2.5 billion, or $68 trillion?
Amazingly, Casey, the answer is D, 68 trillion with a T dollars.
Yeah, we use that number a lot these days, trillion. I think
lots of T's.
The next stage, it won't be millionaires anymore, billionaires anymore. It'll be trillionaires. You know, in the future, that'll be the common millionaire somewhere down the line. That is if Uncle Sam doesn't take a big chunk of it. Yeah, that $68 trillion is as much as $68 trillion of wealth will be passed to succeeding generations. However, it could be significantly less if you don't do a good job disinheriting Uncle Sam and also doing a good job with your estate planning. We had one article in our past weekend reading for retirees that said, these are the 5 estate planning disasters you want to avoid. Not properly designating your beneficiaries, putting down a minor as a beneficiary, failing to fund a trust, creating a tax nightmare for your heirs, and not going through the estate planning process in general. There are some basic things you can do for estate planning if you have a typical situation. Sure. Most of you can accomplish your estate plan by simply hopping online, go to LegalZoom, and you can probably draft the majority of the documents you need, and 99% of your issues will be taken care of with good beneficiary designation. However, you may face a more complex situation. Maybe you have significant wealth. You have charitable inclinations. You are well past the estate tax threshold. Maybe you have properties in several different states. Then you may need to hire an estate planning attorney and spend a little bit of money in order to get that done. Mm-hmm. And it's a little bit of money because it's all relative to what it can cost you to get it wrong. Mm-hmm. I'm a huge proponent of estate planning myself. I like to work with my estate planning team twice a year. And it's great that we have a team here that has great relationships with estate planning attorneys, and we often bring them in to our visits with the families we work with, so we have the whole team on the same page. We sent out an article in our Weekend Reading for Retirees email series this past Friday that was titled Estate Planning for Black Sheep Beneficiaries. Ooh. And that particular article was sourced from Kiplinger, and I sent that out in the weekly email I send out. If you're signed up for Weekend Reading, you receive that email with commentary for myself. It's all designed to keep you on top of the latest trends in retirement planning. You can sign up at retirewithpurpose.com. You can also get a link to this article if this one interests you, and our full-length discussion at retirewithpurpose.com under the podcast tab.
Yeah, this is a great article. Kara Duckworth, certified financial planner professional, wrote a great article here, and it talks about something that we run into all the time when somebody says, and maybe it's not the wild child or the black sheep as it's typically thought of here. Maybe it's just you're concerned about one child or another, and they just want to make sure that they put their plans in place to protect those individuals and their wealth.
The key element of the article here, what I highlighted the most, I guess the broadest highlight that I have throughout the article is that it's essential to consider your individual beneficiary's circumstances when it comes to estate planning.
Right.
And I think far too often it's just, well, we're just going to split it across everybody.
Yep.
You know, we're just going to put it down for the kids and not consider their individual circumstances. And some of those, maybe you're worried about substance abuse. Maybe you have a son or a daughter-in-law who's financially irresponsible. Maybe someone has mental illness. There may be siblings with different levels of motivation, different financial positions that they find themselves in. Perhaps you want to incentivize certain behaviors that they're going to have in the future. There are many reasons for you to do more advanced estate planning in order to ensure that you're managing those individual circumstances that all of your beneficiaries will have. And that's number one, most important, what you need to be considering and what is also most often overlooked.
Yeah, and she says here, inheritance can be problematic. That's absolutely right. But in order to avoid some of those problems, you have to understand that there are several myths about how estates must be distributed. And the first one is myth number one: you must divide your estate evenly among your beneficiaries.
That's not true, right? Not everybody has to receive the same amount. I've seen many kids that are getting completely disinherited, right?
Right.
I worked with a couple that had one child that was struggling, financially, but not that they were concerned with his level of motivation. They were disappointed with him in any way. He just wanted to go down a different route. His passions weren't in making money.
Sure.
He had different passions. In this instance, it was an educational passion. He liked the field of education, and they knew he was helping people. But the other child that they have was a physician that was creating a significant amount of wealth. And that child didn't need any of the assets that they planned to leave behind. So they were leaving the vast majority of those assets to the child that wasn't as financially well off. And there's other reasons to do that as well that aren't discussed in this article. Not just one might need it more than another, but what if you leave the IRA assets to the child that's making $500,000 a year? Uncle Sam takes half of that. Or do you leave the IRA to the child that is, paying, making $50,000 a year and is going to be able to keep 90% or 80% or 70% of those assets? You want to consider that as well. Maybe it makes sense to leave the after-tax assets to the one in higher income tax bracket and the tax-deferred assets to the other child. And that is another consideration. You have to think, well, what tax rate are they going to pay? Who's actually going to get the majority of this? And most importantly, who do you want to receive the large majority of the inheritance? The children at the end of the day or Uncle Sam? It makes sense to do that type of tax planning as well. And that's another reason to kind of mix it up.
Well, and you talk about the changes in tax law and how IRAs are inherited here with the changes in the Secure Act. Those assets have to be pulled out of that IRA over 10 years. And Casey, that's a situation where that higher income child is going to be at a much higher tax rate. So the changes in tax laws can also impact your estate plan. And that's why these things have to be talked about every year?
Well, I have a couple we've worked with for over a decade now, and they have a special needs daughter. It's their only child, okay? And this article talks about, well, if you have a disabled child, maybe you want to leave more assets to them to make sure that they can cover their healthcare needs. However, they may lose some of their government benefits as well, and they never had a special needs trust established in order to make sure that those benefits weren't lost. And that's one of the things we help them with, is to establish that special needs trust with the help of an estate planning attorney to make sure that, again, the beneficiary gets maximum value from all of those different income sources.
Yeah, myth number 2 goes into, once you've disinherited the wayward beneficiary, you cannot change your mind.
I change my mind all the time.
Sure.
And I've changed our estate plan several times over the years.
And it'll probably change more often.
Well, yeah. And I was having this discussion with my wife because we have an incentive-based trust, which is kind of covering myth number 3 here, that says you cannot control things from beyond the grave. Well, you can control things from beyond the grave. And that's one of the things that we have set up. We've got a 0-year-old. We've got a 4-year-old. We have a 6-year-old. And none of them do I trust. And so we need to have a trust established. And
I see what you did there. When you don't have trust, you need a trust.
We don't know what they're going to be like when they're 25, 30, 35 years old. And leaving them a large lump sum, if we were to pass away tomorrow, could be very detrimental to their future. So today we have an incentive-based trust. They have a matching income trust. So after they graduate from college, they make $100,000, they get $100,000 from the trust. It's upon our death, it's split into 3 separate trusts, and then they have matching income that comes from that, and then it will then pass on to charity in the future down the road if they don't get motivated and make some money. I don't want our children to be trust fund kids.
Right.
I want them to be motivated. I want to support them, but I want them to be motivated and driven to create their own life, design their own life. And that will change. If we get to a point when, let's say we're still here and they're 30 years old and we find that they've all been financially successful, they're all very financially responsible, then we may just say, hey, let's get rid of that. Let's just leave them lump sums, and we avoid a lot of the administration cost that comes along with administering a trust like that over decades.
Yeah, and it's going to go into that here in a second. But yeah, there's cost to this, managing a trust. But sometimes, like you said, you can change your mind. There's situations that change. There's tax laws that change. You may want to revisit this on a regular basis. Myth number 4, how to bust it. Trusts are complicated and a pain in the rear to administer.
Yeah, and that's they don't have to be complex at all, and they don't have to be a pain to administer either. They don't even have to cost anything for you to have them managed for the most part. And initially, we have Marshal here as our trustee.
Hey.
And so when we pass away,
and
he
I'm not
will
going
be
to
the
get paid
trustee.
anything. So rest assured.
But you might have a friend or family member like a Marshal that is going to manage that trust. If you don't, like if Marshal passes away, we have a corporate trustee that steps in. That's where there's fees incurred.
Sure.
And for a 0.5% to 2% a year is kind of the range. Say typically 1% a year you're going to pay a trustee. Then of course you have other costs involved. You have money management costs from the financial planner, maybe estate planning attorney, filing costs. It can be expensive to do that over an extended period of time, but that price might be worth it in order to do the best thing for your family. And if you're trying to figure out what's best for your family, we're here to help. We're offering a complimentary financial review to meet with an independent financial advisor on our team, either in person or through a video meeting from the comfort of your home. You can do this in person. You can do it over the phone even. We'll help you determine how prepared you are to handle all the pitfalls that you'll face in retirement. We talked about the estate planning pitfalls, but there's also inflation. There's the risk of rising taxes today. We'll provide you with a tax analysis. We'll provide you with a comprehensive financial plan. In short, we're here to take the guesswork out of financial planning, and it can take just 30 minutes. So give us a call right now, 866-482-9559, a comprehensive financial review at no obligation. That's 866-482-9559, 866-482-9559. We're going to be right back here with you next week on Retire with Purpose.
First-time callers are eligible to receive one in-stock book per request. Limit one book per week per household, up to 3 books per calendar year. See full terms at howardbailey.com/terms. You've been listening to Retire with Purpose, hosted by Casey Weed and Marshall Johnson. Investment advisory services offered through Howard Bailey Securities, LLC, a registered investment advisor. Working with Howard Bailey Securities, LLC cannot guarantee investment success or that specific financial goals will be achieved. Certified Financial Planner Board of Standards, Inc. owns the certification marked CFP and Certified Financial Planner in the U.S., which it awards to individuals who successfully complete CFP Board's initial and ongoing certification requirements. Howard Bailey Financial is a registered trademark of Howard Bailey Financial. All rights reserved. Information is not intended to provide specific legal or tax advice. Howard Bailey Financial nor its advisors are qualified to give tax or legal advice. You are encouraged to consult with your tax or legal professional for guidance on your individual situation. This radio show is a paid placement.